Good morning, everybody, and this is the Nedgroup Investments presentation. I'm Trevor Garvin, and I'm joined in the studio by my colleague who's based here in London, Simon Watts, who is a senior analyst on the multi-funds that we manage. Good morning, Simon.
Morning, Trevor.
Just some brief questions on the multi-funds. So I think it's a good place to start would just be, can you give us a very high-level overview of what multi-funds we have and what are the key drivers of our investment process?
As you know, Trevor, we provide clients with risk-profiled investment solutions. We invest globally and we take a long-term valuation approach. We have a range of 3 products. They are based in sterling and dollars. We are Irish UCITS wrapped products. We have a 7-year track record. They started in August 2011. The range is called income, balanced and growth. Income is obviously the lowest risk profile strategy. And then balance, we have about 40% in equities. And then within growth, we have up to around 80% in equities. So we have a whole suite of kind of multi-asset risk profile solution products.
And in terms of the specific sort of drivers, you mentioned valuation and you mentioned multi-asset class. Or are there any other key drivers in terms of our process?
Yeah, sure. So as I say, we are global orientated investors. We don't want to restrict ourselves to any particular region. So we prefer to look at the investment universe in a global fashion, looking for the best opportunities. We take a valuation type approach, so we're looking to invest in the cheapest areas of the market, whether it be in equities or in bonds. So it's basically, I would say, our global valuation approach, and also a long-term time perspective. We invest over the long term. We don't take short-term positions. And
how has performance been on the funds?
Well, the performance has been very good recently, obviously in the high risk range given performance of markets. The growth funds is up about 19% over this year, and over 7% over the last 5 years. In terms of balance, our medium risk profile strategy, we're up 10% over this year and up just over 4% over the last 5 years. And in terms of income, our lower risk strategy, we're up nearly 4% over the last year and just under 3% over the last 5 years.
Great, thanks. And just to, I think, comment, the income multi-fund also pays income out on a quarterly basis. And am I right in saying it's about a 3.5% yield?
Yeah, it's actually closer to 4, but yeah, we have an income share class and a distribution share class as well. So clients can either take roll-ups in terms of the income or take it in a distribution format as well. But it's around 4% distribution, but you're right in saying it's on a quarterly basis.
Great. Can you just give us a brief summary of our current house view?
Yeah, sure. So obviously the global economy seems to be going great guns at the moment. Obviously we're seeing to see a synchronized global growth impetus and cyclical upturn at the moment. But we have been actually reducing risk within our portfolio. And our large concern, while we're taking more of a cautious conservative stance, is based on valuations. Valuations are quite stretched at the moment, we believe. Certainly in certain markets in terms of equities, we see the US is particularly expensive. So therefore we are tilting the portfolio to more cheaper areas such as emerging markets. I mean, in terms of bonds, obviously central banks have seemed to have been distorting the government bond market. So therefore we don't really own any government bonds. We've been more preferring to own kind of high yield, short duration bonds, where we believe is going to have a better risk return profile.
Great. And just finally to end off, have you been doing any changes in terms of asset allocation or underlying fund selection over the last quarter?
Yes, we have. Actually, we've been gradually shifting away from more defensive equities, stable earners, and increasing our exposure to kind of cheaper cyclical companies, just because we believe we could potentially benefit from this cyclical upturn, especially the change in interest rates. We believe that the kind of more conservative stable earners might face a headwind when interest rates rise. So we've been shifting some of the the portfolio away from Morgan Stanley Global Brands and more into Dodge & Cox. They also have a greater exposure to emerging markets, and we believe emerging markets is still got room to run. They've had a great run last year, but we still believe it's the cheapest area of the market and should still benefit from the cyclical upturn. In terms of fixed income, we've been gradually just reducing some of our high yield exposure and taking some risk off the table, some credit risk off the table, and increasing interest rate risk, just gradually though, as interest rates have been increasing. And then on that side, we've been taking a bit of money out of Cayman's Global High Yield Bond Fund and also AXA Short Duration High Yield Bond Fund, and putting it into kind of Wellington Global Credit Plus.
Thank you, Simon, for coming in today and for those insightful comments.
Thanks, Trevor.
And thank you to everybody for tuning in and coming to listen about the Nedgroup Multi-Funds.